It's hard to avoid the allure of panicky headlines when the Dow is below 23,000 and the Nasdaq has entered a bear market. But for every record stampede of investors into bonds and sudden flood of money into cash tracked by a Wall Street firm, there's a wealthy American making a money move that might seem even more shocking: not doing anything. The latest CNBC Millionaire Survey shows that even as volatility spiked in the period since September, wealthy Americans are not making major changes to asset allocation models. Investors with at least $1 million in investable assets surveyed by CNBC in mid-November, when volatility was already high, said they expected to keep their allocations to cash, bonds and equities similar over the next 12 months. The results are consistent with the previous two biannual CNBC Millionaire Surveys, November 2017 and May 2018, and with the longer-term asset allocation decision-making of these investors since CNBC began surveying them 4 years ago. Wealthy investors surveyed have tended to maintain exposure to U.S. equities of between 45% and 50%, while keeping 15% to 20% in bonds, and 12% to 16% in cash and other short-term investments. When their international exposure is added, the portfolios look similar to the classic 60-40 investment plan: 60% equities/40% bonds. Postload functions equals postload functions pipe. Postload functions. Highchart equals function load scripts array callback var loader equals function src handler var script equals document create element script script.src equals src script.onload equals script.onReady change equals function script.onReady change equals script.onload equals null handler var domnode equals document.get elements batognum body 0 domnode pipe document.body append child script function if array.length equals 0 loader array.shift arguments.cali else callback ampersand callback load scripts https://co.highcharts.com/stock/his.js https://co.highcharts.com/highcharts-more.js https://co.highcharts.com/highcharts-3d.js https://co.highcharts.com/modules/exporting.js function highcharts.setOptions chart render to container events load function this.renderer.image https://fm.cnbc.com/resources/styles/skin/data-visualization/logo-charts.png 10 this.chartsite -15 115 add style font family Gotham Narrow SSM4R title align left X 20 style font size 22px font family Gotham Narrow SSM5R font weight bold text align left subtitle align left X 20 style font size 18px font family Gotham Narrow SSM5R text align left credits ref http://www.cnbc.com text cnbc.com exporting enabled false var options 1 equals chart type pi style font family Arial plot options pi a low point select true cursor true series data labels enabled true title text November 2017 Yaxis title text null credits ref null text source Spectrum Group Zaxis type category series index 0 tooltip value is affix percent name percent data, short-term investments, 14, equities, 46, fixed income, 18, alternative investments, 2, international investments, 10, investment real estate, 4, precious metals, 2, collectibles, 1, other, 4. VAR options 2 equals chart, type, pie, style, font family, Arial. Plot options, pie, a low point select, true, cursor, true, series, data labels, enabled, true. Title, text, May 2018, credits, text, source, Spectrum Group, ref, null, z-axis, type, category, series, index, 0, tooltip, value is a fix, percent, name, percent, data, short-term investments, 14, equities, 46, fixed income, 18, alternative investments, 2, international investments, 9, investment real estate, 5, precious metals, 2, collectibles, 1, other, 4. VAR options 3 equals chart, type, pie, style, font family, Arial. Plot options, pie, a low point select, true, cursor, true, series, data labels, enabled, true, exporting, enabled, false, credits, ref, null, text, source, Spectrum Group, title, text, December 2018, z-axis, type, category, series, index, 0, tooltip, value is a fix, percent, name, percent, data, short-term investments, 16, equities, 48, fixed income, 18, alternative investments, 1, international investments, 8, investment real estate, 1, precious metals, 1, collectibles, 5, other, 16. Pound sign container 1. High charts options 1. Pound sign container 2. High charts options 2. Pound sign container 3. High charts options 3. It shouldn't be a surprise. Investors who have constructed a diversified investment plan based on their financial situation and risk tolerance are not going to run for cover when the market doesn't go in their direction, no matter what a former Federal Reserve chair like Alan Greenspan says. And while recent outflows from actively managed mutual funds have been large, exchange-traded funds have actually been taking in new money and looking at another year of massive inflows. More than $200 billion for equity ETFs, and over $300 billion in all, no matter what a market guru like Jeff Gundlach says about staying away from index funds. Michael Tucci, CEO of Lexington Wealth Management, which manages roughly $1 billion and has an average client portfolio of $2.5 million to $3 million, said there are always going to be times to choose between leaning into the market or being neutral or leaning out. For his clients, it was a year and a half ago when they decided to lean out a little bit based on valuations in the US stock market, but not fears of a systematic contagion. Stocks were really expensive, Tucci said. That means thinking of moving a 60% equities and 40% bonds portfolios to 50-50 or 40-60, but not trying to make extreme moves which are more likely to be wrong. Long-term research shows that investors who do make major moves in response to market volatility are lucky if they generate a long-term return that is equal to the rate of inflation. They sit in cash too long, pull out when market goes down and get way too conservative, and think it is a head fake when the market goes back up. If you're going to make changes, make small moves around the 60-40 portfolio, Tucci said. No two investors are alike, but the investment process is similar. There are important caveats to the millionaire data. To start with, each investor has a unique financial situation, and many investors do not already have $1 million or more in an investment account. There are some 70-year-olds who maintain what seems like a high exposure to equities, 50%, but these individuals may still be working and receiving a significant income, or they may simply not need any of their market money to live on. We have some 80-year-olds who are near 100% equities because they are investing for the next 2 generations, Tucci said. They have more money than they can ever spend. The advisor said there are a few straightforward questions that will do an investor more good than the latest calls from the market pundits. How much do you have in cash? What dividends and interest is your portfolio generating? How much do you currently have allocated to fixed income? When you add up all of that, how many years' worth of money do you have to live? Should you really care about equities being down X%? Tucci said. Over rolling 5-year periods, there aren't many when equities are down by much. And if you don't have a 5-year horizon, you should not be in equities. Show Chapters Doug Boneparth, certified financial planner and president of Bonafide Wealth, said that, even with the markets more or less straight down since the end of November, client allocations have not changed substantially over the last several weeks. However, he said the wealthy do have an advantage as a group, even if each client has a unique situation. Everyone is different, but wealthy people have a greater asset base to work with, and the ability to handle volatility more than someone depending on that income, Boneparth said. They can afford to more aggressive. Among his younger clients, who are still generating significant professional work incomes, they are not all that focused on the market, Boneparth added. They are investing for the long term and more concerned about making sure they are able to continue working. Income is what really matters here. No one is investing for the short term. The reckoning may still be coming. Tucci said having some cash is not a bad thing, as it affords investors the opportunity to get back into the stock market at lower levels, the dry powder. And even as the Fed's rate hike path remains a wild card for the bond market, holding intermediate-term treasuries and long-term treasuries has a proven history of providing inexpensive portfolio stabilization. You build something to be in the game, you build something you can live with through bad times and good times, he said. Over the past month, the Vanguard Long-Term Treasury ETF (VGLT), iShares 20+ Year Treasury Bond ETF (TLT), and SPDR Portfolio Long-Term Treasury ETF (SPTL) have all returned above 4.5%. The tweaks that millionaire investors have been making to portfolios for the next 12 months are just that, tweaks in the numbers that are not statistically significant. The amount that millionaires plan to allocate to short-term investments, cash, money market funds, CDs and treasury bills went up to 16% from 14% in the November 2018 survey. For further reference, it had been at 13% in April 2016. The percentage to be allocated to bonds hasn't budged, 18% in all 3 of the most recent CNBC millionaire surveys, and 20% back in the April 2016 response. The youngest segment of millionaire investors by age, those 55 and under, have increased bond allocations to 14% in the current survey from 10% in November 2017. The planned exposure to U.S. equities, at 48% in the most recent survey, has actually increased, from 46% in the previous 2 periods. Asset allocation next 12 months, by age equities, percent bonds, percent short-term investments, percent 55 and under 45, 14, 15, 55 to 69, 46, 19, 19, 70 and older 50, 19, 14. CNBC Millionaire Survey December 2018. Short-term investments include money market funds, CDs, treasury bills, checking/savings. Overall, these investors do have a positive outlook on the U.S. economy. They are worried more about politics than stocks. The survey was conducted between November 7th and November 19th, so it did precede December, which has been the worst December for the market since 1931. A January reckoning for many investors may still be coming. The thing that stands out to me is that millionaires 55 and older barely changed their equity allocations over the last year, while stocks were generally in a downtrend, said Mitch Goldberg, president of investment advisory firm Client First Strategy. The older two age brackets also held their fixed income allocations fairly stable during the last year, which is a bit surprising. You'd expect to see an increase in this asset class as the stock market trended lower. Then again, these groups have a lot more experience with volatility, and they are not as easily deterred from their allocations. Goldberg said many investors who don't check their portfolio values on a daily basis are still working off numbers in September 30th portfolio statements, and those statements would have likely shown gains for the year. The December end statements are going to present the first annual loss many investors have seen in a long time, and that may lead to a reevaluation, especially when combined with the impact of the tax law changes and loss of many valuable deductions that will become more apparent as tax filing season begins, and other negative signals from the financial markets. For high earners in nearly any state that has a state income tax, the loss of the SALT deduction could mean they face a higher tax bill. We just won't know for sure until after April 15th exactly how much this affects them. Then there is weakness in the housing market, which could affect anyone's personal wealth effect. Throw into the mix stats that point to a slowing global economy and no end in the trade war with China, and we could really start to see those equity allocations come down. Rash moves are a bad thing, but a reevaluation isn't. Market conditions have been so strong over the past decade that advisors have been forced to talk to clients about risk in the abstract, which never works as well as the real thing. Ideally, investors would simply pick the right allocation for their risk tolerance and goals, and simply rebalance, either periodically or based on changes to their allocation ranges because of market movement. With the Dow and S&P down by 10% each so far this month, investors are going to see the biggest drop in account value since at least 2016. We'll see if that could shake investors out of their allocations, Goldberg said. Tucci said when risk actually returns to the market, it is a good time to go back and evaluate a plan and look at how much risk an investor can tolerate. But looking to the latest market panic headlines is not where to begin. Flows are a good contrarian indicator to what you should be doing, Tucci said. I always hate selling into bad times. The CNBC Millionaire Survey is conducted twice a year in the spring and fall. The fall 2018 survey was conducted between November 7th and November 19th among 750 investors with $1 million or more of investable assets. Respondents are required to be the financial decision maker or share jointly in financial decision making within the household.